So if I was to price Netflix based on Disney price multiple, Disney PE, that's what we mean by valuation using price multiples. Current price of Disney is, come on. Current price of Disney is 131. That means for Netflix to have the same PE, and current price of Netflix is 330.61, and it has a PE of that means EPS for the trailing 12 months for Netflix is EPS is equal to P ratio divided by price per share. Remember, PE is price divided by EPS. Hence, EPS is price divided by PE. I'm sorry. So it's 330.61 divided by trailing 12-month EPS for Netflix is 9.7064. If I want to value Netflix based on Disney multiple, in this case PE, I want PE to equal to where is that? 55.73. That means I want price divided by EPS equal that. Hence, I know the EPS, price equals EPS times P, uh, 9.7064 times, I'm using Disney's P, 55 point, where did we go? Uh, 55.73. So based on if Disney and Netflix were to have the same PE ratio, I should have Netflix trading at over $540, but it's trading at 330. So again, in this environment where PE is the proper means to compare two firms, and we're going to think about why that may or may not be the case. We should buy Netflix and short Disney if you're a hedge fund. You know, I'm a hedge fund. Typically, hedge funds don't take directional market risk. They buy something, they sell something else. Okay. In that sense, they're hedged in market performance, in market terms. So, what is wrong with a trade that buys Netflix and shorts Disney based on PE comparison alone? What sort of things could be wrong? Remember, the meaning of the PE is if earnings were to remain at their current TTM levels, trailing 12 months, that's how long it's going to take you to recover your investment. So given that definition, what's the first thing that you would attack? Someone came to you and said, based on PE, I want to buy Netflix and short Disney. What's your first question? Or what's your first objection? What do you see as a weakness or potential weakness in such an analysis? Remember, assumption. If earnings were to remain at their current TTM levels. Exactly. First of all, TTM is backward looking, trailing 12 months, and no guarantee that they will remain at their current level. Remember, you pay a price for a company's share because you expect they're going to make money in the future, right? So the first objection is, why am I looking backwards if I'm investing for future investments? Because if I'm buying this now, those earnings already happened. It is completely irrelevant to me. So the first objection is PE is backward looking. We can easily correct that using what we call forward PE, which is price divided by expected EPS over the next 12 months. Typically, these expected numbers are taken from analyst forecasts, except for very small companies. Most of the mid to high large cap companies have many analysts that are following them, and they make predictions about earnings per share over the next quarter, over the next year, and so on. Financial websites typically also provide a forward PE. Going back to Disney, you could actually, let me see, under financeyahoo.com, if you go to statistics, an estimate of forward PE is right here. Now, that's very different. For Disney, trailing 12 months is 55, and forward expected 24. That means Disney had a bad trailing 12 months in terms of earnings. 24.10, and for Netflix, let's go to Netflix. $29.33. Based on forward PE, you have to buy which one? Netflix or Disney? Disney and short Netflix. So just because you saw that a firm has a very high PE, could be for a lot of reasons, but one of those reasons, they just had a exceptionally bad year last year. Maybe they wrote off something, okay? This potential trade is complete opposite of the trade implied by PE TTM alone. So whenever you make decisions based on price multiples, it's always a good idea to ask that decision is valid if the assumptions underlying that ratio is valid. First of all, it's backward looking. Who cares about what happened over the last 12 months? Market already reacted to what happened to that. But we should kind of look forward because I'm buying future earnings. Whether or not this company pays dividends is irrelevant because any future earnings, if they don't pay dividends, it's going to be added to retained earnings, right? It's going to remain inside the firm. That's the first objection is taken care of by using forward EPS estimates for 1 year.